If the only thing you know about your pension is the monthly amount, here are three things that might be even more important. Because behind that number are guarantees and inflation rules and survivor choices that affect how the pension really plays out. First, is your pension guaranteed and by who? So, a lot of private company pensions are backed by the Pension Benefit Guaranty Corporation or the PBGC. This is generally considered pretty safe, but it is not necessarily backed by taxpayer dollars. So it is funded by insurance premiums that these companies pay into it. The important thing to know is that if your pension plan should fail, then the PBGC may step in and take over those pension payments, giving you whatever you are owed. The thing that catches a lot of people by surprise is this: there are limits on what it will pay you each month. So if you have an especially generous pension, like a lot of money per month, then you're really going to want to look closely at those PBGC limits because you might not end up getting paid as much after a pension plan failure as you were getting before. You'll still get more than nothing, which is nice, but you may need to make some changes in your budget or change your plan. If you work for a government entity, let's say it's a small municipality or something like that, then in those cases, the PBGC is generally not going to be backing your pension. In those cases, you're really hoping that the small government body, let's say, is on solid financial ground. So the revenues that it brings in from taxpayers and the expenses it has to provide whatever services it provides, you have to hope those are lining up so that the pension plan won't fail and they can continue to pay the retirees whatever they're promised. Next is inflation. You really want to know if your monthly payments will increase with inflation over time or if you're just going to keep getting the same amount every month. It just depends on the program. Some do it, some don't, and some, like the FERS pension for government employees, has a weird adjustment, so you need to look at how that works. For example, those FERS cost of living adjustments or COLAs aren't automatic and they don't necessarily match inflation perfectly each year. So if there are periods of high inflation, your spending power might fall behind. And while inflation adjustments are ideal, they aren't necessarily a deal breaker or the end of the world. The reality is that you might have other assets that are going to help you keep up with inflation. So you want to plan for that. And the fact is, the way most retirees spend, their spending amount doesn't necessarily move in lockstep with inflation. And you can look at studies like the retirement spending smile, where people spend at inflation minus 1%, or the stages of retirement, like the go go, slow go, and no go years, where you could be spending less over time. Now, again, having an inflation adjustment or a COLA is ideal, but it's not the end of the world necessarily if you don't have one. What you really want to watch out for is periods of high inflation because that's where it can eat away at your purchasing power. Next, and this is huge, is what happens when you die. So now we're talking survivor benefit. A lot of plans let you choose. You can pick the biggest monthly payment available, and that would last for as long as you live, or you can pick what ends up being a smaller payment, but the plan would continue making payments to somebody for the rest of their life after you die, like a spouse, for example. That's going to be important for your planning. So you always want to look at what happens if one of you dies earlier than expected. It could happen next week, next year, 5 years from now, or 10 years from now. We can't always assume that both of you are going to live into your 90s and keep getting all of that income. We want to look at what happens and what are the survivor benefits. Now, a tip is that it doesn't always have to be a spouse that you choose to get the survivor benefit. It could be a sibling, it could be a child, it could be a longtime friend. So be sure to talk with your pension provider to understand what's available and what are the trade-offs of those different options. That said, if you are married, you may need to get your spouse's permission, also known as spousal consent, to name somebody besides your spouse as the beneficiary. I hope you found that helpful. If you want help with your pension, send me an email, and I look forward to talking with you soon.